Hey everyone, welcome to my channel, the Stock Analyst. So today's video is not regarding any particular stock because I'm going to talk about call option because this thing is applied to any stock, and over my Discord and many YouTube subscribers they are asking for a video on call option because they are very good with the stock trading or investing but they are not sure how to do a call option. So this particular video I want to talk about the call option in a very easy way because you can talk a lot about a call option, but I just want to make it easy and very small, concise, so you know what is the call option. So I'm going to talk about what is a call option, why you should consider option when you do trading as well investing, at the same time how to buy, at the same time some few other consideration, and so that we can all make some money. And if you find this video useful, please do not forget to hit the like button. Do not forget to subscribe to my channel. At the same time, in the first comment, you will see some link for my Patreon so that you can join my Discord and we can all trade together with daily trade ideas, support resistance, those kind of things. So first of all, why you should play some call option. So that's the big thing, right? So I want to show a few things here. So if you see last Friday's action for Lucid Motors, ticker symbol LCID, so at the top you can see that the share price increased by 4.26%. So it was up by only 4.2%. But if you look at the bottom here, you can see the call options, they have increased more than 4%, some of them around 15%, 12%, 16%. So you get more gain with call option. This is a good thing, at the same time a bad thing. Why? Because if Lucid goes down by 4%, your call option might go 15% down. This is one thing. If you play it correctly, you can make more money. The other thing is some people say one call option controls 100 share. So it's not exactly 100, but I will talk more about that. But just want to give you something that if you buy 100 Lucid share, you had to pay almost $3,700, which is a lot, especially for a small account, right? They do not have that much of money. But if you buy a call option, look at the like bid and something, right? So let's say for strike 35, the bid is 5.75. Normally when you buy a call option, you multiply that with 100. So one call option is only $575 compared to buying 100 Lucid share for 3,700. So you see the thing, right? So why you play call option? Because you do not need to use a lot of capital. At the same time, you can get more gain if you play it correctly. So keep that in mind. There is a high reward potential, at the same time very risky when you play with a share. If it comes down and if it never goes to zero, there is always a value. But option has something called expiry date, because after the expiry date your all option money will become zero, so you can lose all your money. So that is why the big risk. Without knowing what is option, please do not play this. Now, if I go a definition, what is a call option? You can go in different places. That an option is then a buy an asset at an aggregated price on or before a particular date. One call option controls 100 share. Let's make it very simple. So look at the glass contained with juice, right? So you know there is a person, right? It's a company. So they make very good juice, and the current price they are selling the juice at $1. Now they are planning to make commercialization and send it over Walmart, Costco, in different places. So you know because of their good taste, the price will not be $1, it will be $4, $5, it will be more, right? So you make a contract with that person saying, okay, by 2021, whatever is the juice price, I want to buy the juice at $2. And for that you pay, let's say, some kind of premium or insurance to that person because you are making a contract. So let's say you pay 10 cents. So if it goes over 2, and if you ever buy it, so you are just paying $2 and that's it, right? So you get it. So if it goes over $2, what is the good thing? If you know it's a good juice, it will be $5. So end of the contract date, this is the expiry date, you are buying the juice at $2, but at that time the market price of the juice is $5, so you're making some money. Let's say in November other people come and say, oh, okay, we know this thing is going up, so what about instead of 2, I will pay you $4, and you do not have to wait till the end of the contract. So you can just sell your contract at $4. So you can buy and sell. You do not have to wait end of the expiry date. The other picture is what if it never goes to $2. In that case, you paid, let's say, 10 cent insurance or premium to the seller of the juice. If it never goes to $2, let's say the price is 1.5. In that case, it doesn't make sense to buy the juice at $2 because by end of 2021, the juice price is 1.5. In that case, you are losing all the premium, which is 10 cent you are paying. So when there is expiry date, there is something, right? You can lose your money. And when I say money, this is the premium you're paying. And $2 is the strike price. We will talk more about it. Just a concept I tried. So when we see many videos or option, you will see in the money, at the money, out of the money, so many things. Just make it very easy. So in the money is, let's say the Lucid share price is 37. So all the strike price, which is below 37, they are in the money. At the money is a strike price around 37, and out of the money is any strike price which is outside. You will see that the bid price for in the money is always higher, and as you go out of the money, the bid price is less and less, because when you buy the call option for 43 strike, it is currently 37. You never know, it will go to 43, so you are paying less premium or less insurance. On the other hand, if the price is 37 now, and you know after 21 days definitely it will be over 27, you pay more. And when people talk about break even, so basically if you buy that particular call option for 27 strike, your premium is 10.6, so your break even is 27 plus 10.6, 37.6. As long Lucid price is over 37.6, then you are making money. So when you buy a call option, you need to look at the strike, you need to look at the expiration date, and do not go with lots of call option out of the money without knowing if it will ever go to 43 or 50. So next one is, I do not want to make it very complicated, but with call option or any kind of option, they have some Greeks, delta, theta, gamma, rho, vega. So the most important thing is delta and theta. So what is delta? So if you go in the money strike price, the delta is higher. You can interpret in two different ways. So 0.87 means if the share price goes by $1, your option premium will go by $87. So let's say you bought the call option for $1. Now if Lucid goes by $1 up, your call option value will be $187. So $87 will be your profit. If you go down, you will see the delta is coming down. At the same time, some people say 0.87 means by the expiration date, there is 87% chance that Lucid will be over $27. But anyway, let's make it easy. As the deeper you go, your delta is higher, you have to pay more premium. The bottom you come, you will see your delta is less, you are also premium, you are paying less premium. So it's a trade-off, right? So what delta you want, what premium you want to pay. Some people always buy at the money, some people just buy out of the money because the premium is less. So you have to decide. Normally anything between 50, 75, 80 delta, I think this is good for me. There is also another thing, something is called theta. This is a time decay, and I'm not gonna go very deep into that. Like this means that each day the option will lose its value by $5, $5.6, meaning that even though the share price is moving sideways, but option has the expiry date, so each and every day this thing comes down, right? So if you pay $10 as a premium and you have only 10 days till your expiration, so each day is like $1. If the share price does not go up as per your strike price, it will lose $1. So theta is also very important. I can make a video only on the Greek. Today I do not want to make it very complicated. So when you set expiry date, you will see lots of expiry dates. Some of them are W, it means that it's a weekly expiry date. Some of them are M, it's a monthly. Each month there is only one expiry date. So 19th of November, then the next month is December, then you see something January. So some people play with close expiry date. Keep that in mind when something is closed, so you have less time, so you pay less premium when you buy the call option. On the other hand, if you have a long expiry date, let's say you buy something after 2 years, so you have more time for the stock to go to your preferred price. So as you're buying more time, that is why you have to pay more money. So long expiry date, some people call leap option. So anyway, If you are going for longer expiration date for the same strike price, you have to pay more. Okay, so how to buy? Few things. Some people buy call, some people sell call. So buying a call means you are very bullish that this thing will go up. Some people also do sell call. Let me know in the comment section if you know, but basically the same thing. So very important thing is what is the strike price. If you have more money, you can go deep in the money, or you can choose something just right at the in the money. Or if you know that the share price will go to that certain price, then you can also choose that strike price. But do not blindly just buy a call option with a 1 week expiration date and your strike price is way like far, because most likely it will never go there, and it will be worthless. So anyway, so when you buy a call option, you need to select a strike price, you need to select the expiry date, and also you need to know are you buying a call or not. So you just buy a call, or in some app it says open call option something. Also look at few things: liquidity and bid and ask. So what is liquidity? I have two examples here, right? The first one is that one stock. You can see the volume and open interest is nothing. There is only 6 people here. There is no open interest. The following one is for the lucid, lots of things. So when you want to buy or sell, you want a very good market, right? Because if you want to sell, you need many people waiting there to buy it or sell it, right? So liquidity is a very important thing. In that case, let's say you have 6 and 0, only 6 people. So let's say you want to sell your call option at $100, but these 6 people, they do not want to pay more than $5. So you do not have any choice. So you have to lower your price. So liquidity is a very important thing. The other thing is the bid ask spread. So you have to see what is the difference between bid and ask. Sometimes they are very close. When you see there is a lots of liquidity, you will see the price is very close. You see 12 versus 14, 92 versus 102. So very close. You can buy your call option using the midpoint, right? Sometimes you will see the spread is really big. Sometimes you will see the spread is like more than like $2. $2 means like $200 for one call option. So always try to get a call option with lots of liquidity. At the same time, look at the bid and ask spread. If the difference is not very much, it means that you can buy it easily, you can sell it easily. Otherwise, whenever you want to sell, you will be stuck. So some of the things, how to lock your profit. Many people always ask, like, should you just execute? So when is the expiration date? There is few options. You can exercise your call option if it is in the money. Let's say your strike price is 40, and by that time the share price is 42, meaning that your strike is below the current market price. So you can exercise. If you do not do anything, your broker will exercise. So I always prefer not to exercise any call option. I just want to sell it. So let's say you buy the call option today at $5. The share price goes higher end of the day, or tomorrow your 5 premium becomes 8. You just sell it, lock your profit. So in that case, you do not have to exercise. You do not need to have the money for exercise. When you do exercise, it means you have to buy 100 share of that particular stock. So normally what I do, I just flip the call option. I buy and I sell. Sometimes this is how it works. So anyway, I do not want to make it very complicated. As I promised, I want to make it very short and very easy. So if you find this video useful, please let me know, and you can put your comments in the comment section below. I can make more videos if you have more questions, because I promise this weekend I will make a video. So it's very quick. I might have missed many important things. So anyway, I also have a Patreon. You can join my Patreon community, and you can get access to my Discord, so that we can all make some money together. You will get trade ideas, pre-market, during market hours, after hour, even for options, shares, crypto, and everything. Anyway, give a thumbs up if you like this video, subscribe, join my Patreon, and thank you very much for watching this particular video. Take care and peace.